Global equity markets have maintained a strong momentum during the course of Q3 2020, following a strong rebound in the second quarter of the year. There are three main factors that have played out. The first one is improved mobility following lockdown restrictions, relaxation. The second one, we've seen better news flow coming from COVID-19 vaccine trials. And the third one, very importantly, has been a massive amount of stimulus, both fiscal and monetary, globally. With regards to this last one, we've seen central banks injecting a lot of liquidity in the system. Central bank balance sheets have expanded by approximately 8 trillion this year alone. And to put it in perspective, this represents almost twice the amount we've seen during the global financial crisis. The impact to markets has been significant. We've seen the S&P experience one of the fastest recoveries from a bear market since the 1930s. The local equity market also benefited from these factors and returned approximately 1% during the quarter, following a strong rebound in the second one. The resources continue to outperform the market quite meaningfully, returning 6% during the quarter, while industrials and financials were approximately down 2%. And this is mainly a result of very weak consumer-related numbers and GDP during the quarter. From a valuation perspective, although we acknowledge that valuations the low interest rate environment can support much higher multiples and valuations, we think that global equity is starting to look fairly expensive. And in contrast, we've seen the local market trading at very depressed multiples and offering as much upside as 30% based on our own calculations. The Onshore Equity Fund marginally underperformed the local market during the last 3 months, primarily due to an underweight position to resources. The level of outperformance of resources over the last 12 months has meant that only 35% of stocks have been able to beat the index. We spent considerable amount of time researching commodities and stock in that space, and even though we admit that at spot prices, valuations look reasonable, we think that bulks in particular and precious metals are trading at very elevated versus its own history as well as cost curves in the industry. For the first time this year, we've seen a rotation into out-of-favor sectors such as South African retailers, banks, and more cyclical ones. But despite this, we've decided to maintain a pragmatic approach to portfolio construction and maintain a good balance of rand hedges as well as high-quality South African cyclical plays. Thank you very much.